Hello, and welcome to How to Save on Taxes, an overview and question and answers with Anil Grandhi. Here we have Anil Grandhi. And before moving on to Anil, a small brief intro about Washington, Seattle Walla. Seattle Walla is a Washington social media platform which is born out of Indians in Seattle. It's a Facebook group working on connecting Indian community in the greater Seattle area. So we connect members with service providers, business, and share the information out of the Indian community as it happens. So here we are with Anil Grandhi, and we would have a session, interactive session with Anil Grandhi on how to save on taxes. Anil, over to you.
Thank you very much. Thanks, Prasad Garu, and thank you, Prasad. And good evening, everyone. Thank you very much. And this session, we are planning to be more interactive rather than one-side presentation. So, and I hope, but still, I would like to give few slides to talk about some basics about the taxes in US taxation. And after that, we'll get on to the Q&A to answer many questions raised from our audience, and also if there are any questions from the chat box, we will take up those things also. And feel free to post your questions in the chat box as required. Whenever you think, if you get any question, just post it in the chat box. Just sharing my screen. Prasad, can you see my screen?
I can. If you want to go, yep, perfect. Or you want to go for a full screen mode, that's even better, or a presentation mode.
Oh, okay.
Yeah, thank you.
Yep. So just in this session, I would like to focus on a bit more on the basics, but try to cover to the extent possible. And maybe we can have a couple of more sessions in more detail on advanced. So so let's get on the topic. So before getting onto the topic, just I want to give a disclaimer. I am just trying to share my knowledge on this platform with my local people. Please don't take it as a tax advice or a legal advice, because from person to person, the tax situation may differ. So I strongly recommend you to work with an accountant or CPA or a tax pro before you implement any of the guidances, what I'm going to discuss here.
Thank you, Anil.
So, yeah, thank you. Yeah, and this is very brief about me. I have 15 years plus experience as finance controller, CFO, and other senior finance positions. I was working for Amazon, Starbucks, PricewaterhouseCoopers, and also Sun Edison. It was the world's largest renewable energy company. So we have been helping individuals and also the business owners by sharing our knowledge and also offering different types of services. We are a team of CPAs, chartered accountants, and other finance professionals. I am also a Forbes Finance Council member. Many of my articles you can see on Forbes, Yahoo, or Business Insider, and also I do also come on a lot of news channels, TV channels as a guest speaker. And as I said, you can see my articles on different medias, including CPA websites and also the restaurant and healthcare industry, and almost in many media channels. And I can proudly say that I'm a Forbes Finance Council member, and you can see a lot of articles which was written by me in Forbes. And if you're interested to save taxes, I strongly recommend you to go and watch a playlist on my name in YouTube, where every video is exclusively designed discussing about one tax saving strategy. So you may focus there. I recommend you to go and watch there. That's about me. So now you understand. So now we are setting up a path to discuss in more technical now. So now, as I said, I want to just focus more on the basics in this session. So, but first I want to bring it to your attention Why do you need to know about taxes? Why taxes are very important? People don't realize it. Actually, taxes are the number one, number one expense in your family. So if you see, you can look into your house EMI. You can look into your how much taxes you are paying. People think your house EMI or house rent is more expensive every month, but people don't realize is they're paying more taxes than how monthly rent or house EMIs. So because IRS wants you, so because IRS wants you, they designed it so nicely. Tax gets deducted from your W2 paycheck, so you don't feel the pain. Even you have some CTC, some salary, but you may not see the full salary because of the tax deductions. So then just I recommend you to spend some time and understand how much taxes you are paying. When we buy a house, we spend so many months, and maybe few people spend time on years to find one good property, to find a property, and to ensure that, and also ensure that the monthly installment is within our budget. But we are paying taxes much bigger than our monthly house installments. But how much time you are spending to save taxes? So this is very important to focus on taxes, and every year I strongly recommend you to look into your numbers and start working on tax planning. Rather than donating to IRS, just find a way how to save taxes in a legal way. So now just let's get onto the topic in more detail. There are different types of incomes we have. The first one I want to start about active income. If you are performing any service, if you are performing any service, and if you are getting paid for the service, it is considered as an active income. It can be wages, it can be salaries, it can be a commission, or it can be even income from your business. But the income from the business, again, a bit small elaboration here. Business means you should actively participate. You may be investing in some businesses, but you are not materially participating. Then it is not active income. So what is an active income? If you are offering any service, or if you are working hard, if you are materially participating, that is called an active income. On top of your federal taxes or state income taxes as applicable, if you are living out of Washington state, you are also required to pay social security taxes, which is 15.3%. So employer and employee together, we pay 15.3% social security taxes. And there is one more income called passive income. So the passive income is where it is like a return on your investment, or if you are investing in a business but you are not materially participating, then it is called passive income. You don't have to pay social security taxes on your passive income. And if you invested money in your rental property, and whatever money you get on your rental property, maybe your monthly rent, after all your expenses, you get a rental income, net income from the rental property. You don't need to pay social security taxes on passive income. And the third one is called capital gains income. Capital gain income is derived when you sell a property or an investment or an asset. So if you hold this property, or it can be even stock, your employee stock options, or if you are investing in the stock market, or if you're buying a property and selling it later, if you hold that property or asset for at least 1 year or above, then it is considered as a long-term capital gain taxes. Long-term capital gain taxes, tax ranges from 15% to 20%, 0%, 15%, and 20%. And if it's a short-term taxes, if it's less than 1 year, it is called as short-term tax. If you hold the property for less than 1 year, it is short-term capital gain.
Okay.
So
do you still have to pay taxes for that?
Of course, yes. Yeah. Sorry. Yep. Short-term. It is considered as a short-term capital gain, and yes, you have to pay taxes at your regular income taxes. Good question. Yes. So you need to be you always try to get more on long-term capital gains rather than short-term capital gain. Because long-term capital gain you need to pay more taxes. Short-term capital gain you need to pay more. Long-term capital gain you are paying lesser taxes. Short-term capital gains you are paying more taxes. So if you want to sell some stock or shares, if you are holding shares, or even it might be you might have received from your RSU, restricted stock units from your employer, just ensure that you are holding it for 1 year at least, so that the tax rate will go down substantially, maybe from 35% to 15%.
Perfect. So the threshold is 1 year.
Yes, threshold is 1 year. Yes.
Perfect. Okay. Thank you.
Yeah. So, and as we are talking about the more basics, so these are the snapshot of the income tax rates, what is applicable for the year 2021. So on average, so if this is for married filing jointly, and this is for the single unmarried individuals. If you're married filing jointly, you will be paying the tax ranges the tax rate starts from 10%. So from the 10%, it can go up to 37% based on what income level you are. This is a bracket system. So for the first, like example, for the first $19,900 of income, you will be paying only 10% of the taxes. But as it is going up, the tax rate will go up only for the incremental rise in the income, not for the full amount. This is a bracket system. This is just like same like in India, how our Indian income tax system works in India. So, and this is what the capital tax rates. If your income rate, if your total married filing jointly, if your income is less than $80,800, your capital gain tax rate is 0. You don't need to pay any capital gain taxes if your married filing joint tax rate of income is less than $80,800. Many people don't know this. And if your income is more than $501,600, you will be paying 20% tax rates. It's not 15%, it's a 20% tax rate for the long-term capital gain taxes.
Nice.
So, and income tax is not so complex, but only thing is people don't spend time on understanding how it works. This is how our income tax looks like. Income tax return looks like. It's a very straightforward for the individuals. Whatever income you make, whatever deductions you get, that's it. It's a straightforward. There are hardly 22 lines in income tax return at high level to understand what is an income tax. So I strongly recommend everyone to understand what are the incomes and what are the deductions. These are very, very important to understand what deductions are there. Whenever you have some free time, I want you to spend time on this, understanding this form. It's very simple form. It's called Form 1040. It's an individual income tax return. If you understand what are the deductions are allowed, boom, that's it. That's all the maximum you need to know to know more about income taxes at very high level. Of course, there is a learning is never limit and never stops. You can spend more time to understand it in more detail. But at high level, I strongly recommend everyone just to review your individual income tax return. You might be filing your taxes before October 15th now. If you file an extension, I want you to read every line and just understand, so that this knowledge will be helpful for you forever, as long as you are living in United States of America.
So do you suggest any website, or is it an IRS website that you would recommend for people to go and read more information about, as you just said, that it is good to understand each line? So would you suggest anything? I know you're not probably going to suggest, but would you say something out of experience?
No, actually, in IRS website, there is some instructions also given. For all these 22 lines, they have given an explanation. What comes under that, what comes under that. That's it. If you spend some 30 minutes or 1 hour, you will have complete understanding of how a tax return works. Indirectly in IRS website itself, you can just look for Google search Form 1040. You'll get an IRS link. Go for irs.org link. From there, go to the instructions and go through that. Otherwise, just look at your individual tax return itself. Just open your last year tax return, your latest tax return, and try to understand. You may not be using every line. Hardly out of 42 lines, you may be using only few lines. So just only try to understand what lines you are hitting. Go to the IRS website, what that line talks about. That's it. We all are I strongly believe all our community members are very intelligent and intellectuals. If you spend very small time, you will understand how income tax works. Because I'm saying many people, because many of my clients come and tell me that hey, taxes are very difficult to understand. No, it's very simple, straightforward for W2 income people. So just I want everyone to go through this. Okay.
Thank you.
Once you understand how the income works, then the most important thing everyone should know is a standard deduction. Everyone, whoever residents in US, if they have if they are a US resident or citizen, even you are an H1B or green card or you are a citizen, everyone has a standard deduction. It means you don't have to pay taxes up to some amount. Like example, if you are married filing joint, if you're filing a married joint filing, then the first $25,100 you don't have to pay any taxes. It's completely free for you, and you don't even need to file a tax return. If you're an individual and if your income is less than $12,550, you don't even need to file a tax return, and you don't need to pay even a single dollar as a taxes on your WT income, if at all any. Okay. So these are the very basics. And whatever income you make, and just I want to give an example. If you're making an income of $100,000, you and your wife together, standard flat deduction of $25,100 flat, you don't need to pay any taxes. Then your taxable income is only $74,900 only. From there, the tax calculation starts. Otherwise, the first $25,100 completely take the piece off from your total income. So
perfect.
Yeah. Then what else? And some people say that why I'm getting only $25,100? My expenses are more than $25,000. Then IRS also has given an option called you can go either for the standard deduction or go for individual tax deduction. It is called itemized. So what does it means? There are some high level. There are 5 categories are listed down in the itemized tax deductions. All these expenses together, if it exceeds $25,100, then you can go for itemized. Then you can deduct more than $25,100 in your tax return, and you don't have to pay money up to this extent. So what are those 5 deductions? The first one is state and local tax deduction. So to the maximum of $10,000. Fortunately for our Washington state, there is no state taxes at all.
No state taxes.
But there are some property taxes which we pay. That comes under here. So and if at all, if you have any other income from any other states, then you may need to pay state taxes there. But all these state and local taxes together, including the property taxes, to the maximum of $10,000, you can consider under this bucket. The second one is medical and dental expenses. It is 7.5% of your adjusted gross income. If your medical expenses are more than 7.5%, example, if your income is, if your adjusted gross income is $100,000, it means 7.5% is $7,500. If your income is more than if your medical expenses are more than $7,500, then the on top of the 7.5% amount, whatever amount is there, you can get a tax deduction under this. Most of the scenarios, you don't use this line unless there is some family emergency, or you met a bigger accident, or there are some major medical expenses at your home. Most of, with my experience after going through hundreds of tax returns, my experience is most of the scenario, our medical expenses are less than 7.5% of our total income.
I see.
Then the very popular one is mortgage interest reduction. So if you take a house on mortgage, and if you are paying any interest on the mortgage home, then those expenses are tax deductible under itemized category, provided there are some conditions applicable. If you're taking a house after December 15, 2017, the maximum amount is only $750,000. So otherwise, if it's before, it is $1 million. Otherwise, after December 15, 2017, they brought it down to $750,000. An example, I live in Bothel, and I have a mortgage loan of $900,000. So I have to do the calculation. What is my interest payment for my $750,000 mortgage only? Only to that extent, the amount is tax deductible. Otherwise, on top of $750,000, it is not tax deductible.
I see.
Okay. So then charitable contributions. So if you do any charitable contributions, you may be going and doing any charity activity. We are so fortunate. We are making, God blessing, we are making some decent size of income. So at the same time, it's our responsibility to take care of our community. If at all, if you are doing any charitable donations, those expenses also tax deductible here. And on top of that, if there are any natural disasters from in your community, and if government declares, like example, recently in New Jersey area, there were floods, so it is considered as a natural disaster for that area. So in that circumstances, if you incur any expenses, they also come under this bucket. But in our Seattle, I have not seen many times, because our weather is always decent good. It's not extremes most of the times. So, but if at all, if you incur any expenses in those cases, those expenses also can be considered as an itemized. All these 5 categories together, if our expenses are total is more than $25,100, then yes, you can get a tax deduction for your, you can get more tax deduction than $25,100. Otherwise, it's a flat $25,100. Whether you have expenses or not, doesn't matter. Yes, sir.
Okay. So when you said disaster declared by the president, does COVID come under a disaster? Because it was announced by the president.
Correct. But here we're talking about more about the property damages, or a personal casualty, means any personal property is damaged.
I see.
In those cases, like example, some flood, or otherwise some thunderstorm, or maybe
natural disasters.
Natural disasters, I should say.
Yeah. I see. Okay. All right. Thank you.
Okay. So this is at very detailed level, but I hope this is very helpful. If you understand this, then you will know the game, and you play well in the game to save taxes. And at very high level, home mortgage interest, because this is so popular in Seattle market. So I want to reiterate that the maximum $750,000 only, to the extent interest what you are paying up to the mortgage loan of $750,000 is only allowed as a tax deduction. On top of that, you can also deduct any mortgage points or late payment charges on a mortgage payment. And also, if there are any prepayment penalties for prepaying your mortgage debt, so any prepayment also can be deducted. And the last, very important, is 2 primary homes are deducted. But assume, like example, I want to give an example. I have one house in Bothell, Seattle, one in my hometown in India. So I get a tax deduction even for any mortgage interest I'm paying, even for my Indian property also. So you can have 2 primary homes anywhere. So, but not within the radius of 50 miles. So this is the requirement.
Okay. Thank you.
Okay. So then that is a very high level to understand how a tax return works and everything. So now I want to just focus on very popular tax saving tips. So the very popular one is health savings account. This is one of the best tax saving tool IRS has. So how does this work? Health savings account you can open. Not everyone is eligible to open a HSA account. You have to have a high deductible insurance, medical insurance, health insurance policy to open HSA account. If at all, if you have high deductible medical insurance policy for your family, then you can open an HSN account and you can contribute up to $7,100, and it is completely tax deductible. And this money can be used for any of your medical expenses. So it can be for copay, or it can be if you want to buy some pharmacy or medical, anything like medical related, you can use this account to spend. And there is no time limit. Once you contribute $7,100 in your lifetime, even after 70 years also, you can use this money to take care of your medical expenses. So this is a very good tax saving tool, I shall say. So then very popular one is 401k. I have seen many individuals are not opting in for 401k account. This is a blunder, or this is a big mistake what people are doing. I strongly recommend everyone to have a 401k account to maximize it. There are some conditions which I'm going through now. So I strongly recommend everyone to contribute to the 401k because there are because the first one, whatever you are contributing, they are tax deductible. Like example, $19,500 is the maximum you can contribute in the 401k account. If in this $19,500, if you invest somewhere else, what we do with our money? We eat some for our eating living. Remaining every money we save somewhere. Generally, the rate of return for all our savings are maybe, even if it's a good one, maybe 5% or 10%. But if you invest in your 401k account, you may be getting a flat tax deduction of 30% or 35% or 37% based on your income levels. And many people are missing employer matching, which is it's a free money. Many people are missing that. I strongly recommend everyone at least to contribute up to the employer matching. Like example, if you're working in a Microsoft, employer do 50% of your contribution matching. An example, if you're contributing maybe $18,000 in your 401k account, Microsoft will contribute $9,000 for you. If you're not optimizing this, you are losing every year $9,000 free money from your employer. That over the time, it could be maybe hundreds of thousands of dollars, or it can be even millions, because there's the power of investment. So in the long run, it could be hundreds of thousands of dollars. So don't ignore your employer matching and the power of compounding. You, at least with this habit, you started saving the money, and it's a power of year on year, it keeps compounding. You may be seeing some hundreds of thousands of dollars by the time of retirement, which will be very, very helpful for you, whether you settle down in the US or in India. So then, and whatever you are doing a contribution now, it is called traditional tax. Sorry, if you want a tax deduction, it is called traditional contribution. If you think that I don't want any tax deductions now, but I want to enjoy the profits later, it's called Roth. So an example, in the same example, $18,000, if you are contributing now, you get a tax deduction. But if you go for Roth 401k account, whatever you contribute now, you don't get any tax deductions now, but in the future, at the time of retirement, whatever money you take it out, it's completely tax-free. So this is one of the very powerful tool for 401k. Don't underestimate 401k account. So, yeah. And this is what the contribution limits. So you can contribute up to $19,500. If you are more than 50 years, you can contribute up to $26,000 for a 401k. You cannot touch your 401k account until you touch. Until you touch 59.5 years. Before that, if you want to take it out, there is a 10% penalty, and you also need to pay taxes. And of course, even after retirement, you take the money, you need to pay tax. Even after 60 years, if you take the money, you have to pay taxes because you are enjoying the benefits now. Yep. Okay. So I want to cover one more cost strategy called IRA, individual retirement account. Many people are not contributing for this. I strongly recommend every one of you, whoever watching this live show or maybe recording, you should have independent retirement account. It's called IRA. Every person can contribute up to $6,000 to IRA account. And if you're more than 50 years old, you can contribute up to $7,000. You get a tax deduction if you're married filing jointly and if your income is less than $124,000. If not, you don't get any tax deduction, but you can still contribute to the Roth IRA account. You don't enjoy the benefits, but you enjoy the benefits in the long run. So maybe in the upcoming webinars, I will discuss more about the IRA, but considering the shortage of the time, I'm not going in detail. But IRA is one of the very, very powerful tool, and Roth IRA is a great strategy. I don't want anyone to miss. If anyone doesn't have an IRA account is not required to be supported by an employer. Your employer will not sponsor. Google search, you can open IRA account, maybe with Fidelity or Vanguard. There are many service providers who offer IRA account. And if your income is less than $124,000, whatever you contribute to IRA, up to $6,000 for you and also for your wife. Even the wife is not working, you can contribute to IRA. The entire amount is tax deductible.
Perfect.
Yeah. So, and I'm just considering the shortage of the time. Let's get on to the Q&A because we already completed 30 minutes. So just get on the Q&A. Thank you very much,
Anil. That was wonderful. That was a lot of information. I'm sure the viewers who are following this webinar will have tons and tons of questions and a lot of clarifications probably they can get online. And I just want to ask a quick question. How do you suggest any? You said you have a link, you have a YouTube channel or presentation. Would you like to share it with the audience today,
Sure,
or you
definitely.
can do it at the end of the conversation after the questions?
Yeah.
So I have a few FAQs. Just want to start off. I don't think we did talk about the itemized tax deductions versus the standard deductions. You did give a brief explanation. So I would just ask, which one does suit me, and how do I find it?
It's a very straightforward question for most of the people, most straightforward answer for most of the people. Most because we don't have the local state taxes, unless you have the home. If you have a mortgage, if you have unless you have a primary home and if you have a mortgage, then you may be eligible for the itemized. Otherwise, you may come under standard. Otherwise, the other second alternative might be you may be doing a lot of charitable donations. Imagine, think about $25,100. If your charitable donations on an average more than $10,000 to $15,000 per year, then you may consider under itemized. Okay. I mean, any one option. Either if you have a mortgage home or you are doing a big charitable donations, then you may come under itemized. But I strongly recommend you to check with your tax return filer to go through which suits for you, because as I said, we need to plug in all the numbers in those 5 buckets, 5 categories which I mentioned. So after once you add all those numbers, and if the total is more than $25,100, then yes, you come under itemized. Otherwise, it's a standard deduction.
Perfect. So how does the W-4 really play its role in tax savings?
Okay, so W-4 is a very important tool for every individual who are working as an employee, because employers has an obligation to deduct taxes from your salary, but they don't know what is your family structure. They may not know what is your family structure. So IRS says that ask the individual. Every individual has to submit a W-4 form by giving about the details about how many withholding tax how much they have to withhold. There is some different calculations are there, but based on your W-4 declaration only, how much taxes a company has to withhold your taxes will be decided. So it's very important. And whenever there is a changes in your family structure, maybe you may have a new baby at your home, or otherwise you are relocating place, you are living in a different state now. So those are they play a very key role, which has an impact on your taxes. So I strongly recommend everyone here and there to double check whether what your W-4 is talking about. Otherwise, you may be paying more taxes to IRS in advance. Of course, whatever taxes are withholding from your W-2, it will be deposited with IRS whenever you file your taxes. If you paid more, you'll get it back. But why do you want to pay more? Be reasonable. Yeah. Why do you want to keep the money with your IRS? With IRS, that money you can use it and put it to invest in the stock market or maybe something else. So.
Right. Awesome. Thank you so much for answering that question. We have a couple of questions in the chat. Radhika is asking, is IRA 6K limit separate for spouses or combined limit?
Okay, it's individual 6,000. Individual. So it's for family, it's $12,000.
Perfect. Jaydeep has another question. What kind of proofs do I need to show if I am paying home loan in India?
It's a simple, straightforward. The lender will give you an interest payment document at the end of the year for the given period from the January to December. Just you need to get the document. That amount, whatever the interest you paid, you need to give it to your an accountant or tax guy. So he will consider that amount. That's it. That's one is enough.
Thank you. Thank you, Radhika and Jaydeep, for the questions. And anybody on the call who's listening to our conversations, please do ask your questions on the chat. And as I keep going into my FAQs, I will include your questions as well. Let's get to somewhere about the taxes by the end of this session. Anil, 401k contributions, how effective is this? And people who are on H-1Bs, is really a good option for them?
This is a very good question, very frequent question which I get. I strongly recommend to contribute to the 401k for everyone, by everyone, because there are two categories. Number one, if you don't contribute, you may be missing employer contribution. Employer contribution is a free money. Don't miss that. I have seen many people take so many years of time to realize that mistake. After that, they will start contributing it. So, and if the people are planning to go back to India, still it is recommended, because whenever you leave your job, you have an option to convert that into the IRA account. IRA is more flexible than 401k. So IRA you can invest wherever you want. So there are called self-directed IRA. There are regular IRAs. Even you go back to India, still you can continue to hold the money in US, either in the 401k account or convert this into the IRA account. And however, if you want to withdraw money when you want to when you are going back to India, that is also absolutely okay, because you will be paying 10% penalty, because you got a lot of free money from your employer, and after that you are paying only 10% penalty. And once you go back to India, your incomes are lesser compared to the US, so your tax brackets are lesser. And if you are a non-resident Indian, immediately after you move to India, there are different tax sequences are there. I don't want to get into the more detailed Indian taxation, but still I recommend everyone to contribute it, considering if you can contribute, you can convert to the IRA or withdraw money later, but don't lose free money from your employer.
Understood. Thank you. So how about investing in IRA, Roth IRA, etc., that you did explain a little bit? Would you give more pointers around
Yes.
that topic?
IRA is my favorite area, my favorite place. In the entire IRS code, Internal Revenue Code, with notifications and clarification sections and everything together, it is a 70,000 pages document. In the entire 70,000 pages document, only one word I love is Roth IRA, the most powerful one. If anyone doesn't have the Roth IRA account, they are missing a great opportunity. People don't realize it. Whenever you file your taxes with your CPR and accountant, how much time he's spending time with you to explain what is important? If he's not spending time, then you are missing a lot of opportunity. So everyone should have an IRA. The reason I will explain now why everyone should have an IRA. First of all, the limits you can contribute is $6,000. You and your wife can contribute $12,000 every year. Year on year, you can start accumulating. And if your incomes are less than $124,000, then only you get a tax deduction. But with my experience of having hundreds of clients in Seattle area, the average income in Seattle area is, for our Indian community, is more than $124,000. So most of the cases you may not get a tax deduction.
Right.
But still, I recommend you to contribute to Roth IRA account. Roth IRA account is the powerful tool, because whatever money you contribute now, you don't get a tax deduction, but that money you can use wherever you want, wherever you want. You want to invest in the real estate, you can invest. You want to invest in the stock market, you can invest. And whatever money, every year you may be, most of our Indians, we invest money in stock market. And you get a capital gain taxes. You get a capital gains and you need to pay taxes. Or you may be investing in the real estate. Whenever you sell your investment property, you will be paying taxes. If it's a Roth, if you can invest from the Roth IRA account, completely tax-free. You don't need to pay any taxes forever in your lifetime if you don't touch the IRA account till your retirement. So, like example, every month, if you are putting some $100,000 in the stock market and every day you are doing a trading, rather than doing the trading from your regular investment account, do it from the Roth IRA account. Whatever the 100 may become 500K or a 1 million or 10 million. There are many people, like I want to give one example here. There is a guy called Peter Thiel. He started contributing in 1999 into the Roth IRA account. Every year he contributes only $6,000. Right now his balance is $5 billion. So because he invested money in the Facebook and PayPal, and those valuations are too big now. Right. Just only from this thousands of dollars only he invested, and whatever money, the $5 billion, if he's taking out when he's at his retirement, he doesn't need to pay even a single dollar as a taxes. So that is the power of Roth IRA account. And
we have another question from JD. Can I contribute to both 401k and traditional IRA? What is the limit of traditional IRA?
Yes, you can contribute. Even Jeff Bezos can contribute, Warren Buffett can contribute, I can contribute, Prasad can contribute, anyone can contribute to IRA account. But the point to be noted, you can contribute, but do you get a tax deduction or not is matter. So if your income is less than $124,000 joint filing, then you get a tax deduction. Otherwise, you don't get a tax deduction. But then in that case, I recommend you to contribute to the Roth IRA account. But if your income is more than $206,000, then there is a concept called backdoor IRA, but that takes more time to explain. But in our next session, I will explain that in the advanced tax planning.
Yeah. Thank you, JD, for the question. And everybody else who's on the call, if they have any questions, please let them come in. I will take time to ask the questions, and Anil will be able to answer them for you. I'm going to move on to the HSA. So can you please advise how it can actually be used for saving taxes?
Yeah, HSA, I think we covered in detail in one of the slides. Health savings account, everyone can contribute $7,100 provided you have a high deductible insurance plan. If you don't have a high deductible medical insurance, health insurance plan, then you are not eligible for the HSA. So, but and that is after IRA, HSA is also plays a very key role, because when you contribute, you get a tax deduction, and this money can be invested in the stock market. You don't have to use it immediately. You contribute, you get a tax deduction. You can use this account to invest in the stock market on online, and that can grow. Maybe this year I contributed $7,000. This $7,000 will be invested in the stock market, and it grows. After 20, 30 years, the $7,000 may become $25,000, and at that time I can use it for any of my medical expenses, completely tax-free withdrawals for the medical expenses. So
very nice. So we also hear about the FSA, the flexible spending account.
Yeah.
How does that help? And also, does FSA dependents will they be able to save money for the kids?
Okay. So FSA, I shall say there are whatever you contribute in FSA, you get a tax deduction. But there is some problem with an FSA. So it's like if you don't use the money by end of this year, the money will be lapsed. So you need to be very choosy. You need to be calculative on how much money you want to contribute to FSA account. In FSA, you can contribute up to $5,000 for if you're married, if you're filing jointly, and the $5,000 can be a tax deduction. This money can be used for any of the medical expenses or for your kids. Dependent care FSA, it's called. It means if your kids are going to daycare, this money can be used to pay your daycare expenses. So, and if at all, if you don't use it by end of the December, 31st of the end of the year, you will be losing the money, whatever the money you have left over. But for this year, for the year 2021, because of the COVID regulations, government extended to use these funds by next year, because many kids are not going to daycare, so that they're losing the money. So you have time, one more year extra to spend your FSA account.
Perfect. Thank you, sir. Moving on to the next question, the donations. So give it away. So how does this actually save taxes for us?
Got it. First of all, I recommend, I personally do, and I also recommend all to community members, be flexible or be be generous to give the donations. Be generous to give the donations. Just to encourage you, government is also giving you some support from you, support from their side also. In general, if you are filing a standard tax return, it is, if you remember our earlier conversation, you don't have a mortgage home, or you don't have the 25,000, more than 25,000 expense. If you're not an itemized, the basic one is standard tax return. Then whatever charitable donations you do, you don't get any tax deductions.
Right.
But there are some exception. I will explain them then. So you don't get any tax deductions. But if you're under itemized tax deduction, if you remember 5 categories which I explained,
Yes.
one line is charitable donations. You can match for this year, for the year 2021, you can give 100% of your income as for charity. But otherwise, it is only 60% every year. Whatever money you make, up to the 60%, you can, to the maximum of 60%, you can do the charitable donations. And for the standard deductions, only for this year, if even you are under standard, like example, I am filing my tax return under standard, but I do then if I do any charitable donations, I don't get any deductions. But because considering the COVID scenario, IRS said if you're an individual, you can deduct $300. If you're a family, you can deduct up to $600 as a charitable deductions, even you are a standard tax return filer.
Oh.
But this is only for this year. From next year onwards, it is not there.
Okay, for 2021.
Yeah, for 2021 only.
Okay, thank you. So we did talk about the medical expenses, the 7.5% adjusted gross income. So what if it is more than 7.5%? Is it a tax saving?
Yeah. No, I mean, as I explained in my presentation, if it's more than 7,500, 7.5%, then only you get a tax deduction. Otherwise, you don't get it. So, but just it's good to know. That's it. And actually, this provision is more about not more about tax savings, but more about the cash flow. So you will be saving some money if it's more than 7.5%. Very rarely, even I have few hundreds of clients, but very rarely I see that our expenses are exceeding 7.5%. That's it.
Okay, thank you. So where can we find all the itemized eligible items for the tax deduction with a maximum limit? Any suggestions, any websites that you would recommend for our viewers?
Initially, I covered one slide, how the tax return looks like. And there is a form called Schedule A for Apple, Schedule A. This is the form. It's a very simple one-page form. You can just look at it. Again, it has only 4 or 5 categories. Whatever I explained in my presentation, the same thing you can see there in line items. So I recommend you to watch under Schedule A form, tax form in IRS website. But because every year you have to live with the taxes, just better spend some time, understand what is there, so then you'll enjoy what's happening. Otherwise, you always hate taxes.
So quick question around that. You said it's a every year thing. Everybody has to go through this. I do understand some people go to the professionals to do. Some people like me sit at home and do my taxes. So does anything change every year, or usually is it standard for many years? What is your experience?
Very good. It's a good question. Every year will there be some change? Maybe yes, but not material. There may be sponsor. The tax code is the standard. Here and there, like example, this year there the charitable donations of extra $600 is there. From next year it won't be there. But the basic tax returns are the same. And every year IRS prepares a new form. I mean, they may be doing small changes in line with the recent announcements or recent changes. So there won't be any big changes. The biggest tax reform has taken place from 2018 onwards after Trump has come up. Trump helped to completely streamline the tax return filing process. Earlier, we used to deduct a lot of expenses, but from 2018 onwards, they said standard deduction is $25,100. That's it. Don't ask me more unless you come under itemized. So there won't be any more deductions. They simplified it. But one recommendation I want to tell you, I appreciate that you are doing it on your own, but I do see a lot of mistakes when people file on their own because they don't realize the mistake unless they get a notice from the IRS. So, and it is not your cup of tea. It's just only a couple of hundreds of dollars, and reasonably, God blessing, in Seattle market, our cost of most of them makes very good money. It's absolutely worth to spend a couple of hundreds of dollars and get the work done from a professional, unless you have only W2, then nothing else. If you have only W2 income, yes, TurboTax might be good. It is good. It has auto futures where you can read, you spend time and file your taxes. But if you have anything more than W2, including RSUs, I strongly recommend you to go to the tax professional, get the work. The work, I mean, it's like a delegate. Everyone is a professional in their jobs. So I mean,
Yes.
you have to do what you are supposed to do. Don't try to put your hand in everywhere. You'll get tax return is the most important document in the year. Why do you want to compromise? I know that people are comfortable in doing on their own, but you may be doing some mistakes or you may be missing something. And the advice, what you get in advice, the advices you might be missing. So
right.
Yeah.
Perfect. Thank you. That's a great suggestion.
Yeah.
So Jaydeep has another question. He asks, what are the ways, such as 401k, to reduce the AGI, annual gross income?
Okay. So if I as I explained earlier, if you look into the schedule 1, you will find some details, but I will tell you at high level what are the, for an individual, what all you can do. Apart from the 401k account, you can also contribute to HSA account, health savings account, which I explained. Then you can also contribute to FSA account, flexible spending account, up to $5,000. HS account, $7,100. 401k, $19,500. And you can also contribute to IRA up to $6,000 for you, $6,000 for your wife. And if you have any student loan interest, but if the income levels are smaller, then only you come under that criteria. If there is any student loan interest also there, that amount also can be deducted. And this is for the individuals. At a very high level, this is what I can think of. But I strongly, your situation may be different, but I recommend you to work with your advisor also. But at individuals, tax savings are very less. But if you're a business, the game starts. Every person has to start a business. We'll cover if time allows. But
okay.
Yeah.
Great question, Jaydeep. I hope many of our viewers would be benefiting from your questions. Thank you so much. And everybody else on the call, please let the questions keep coming, and we'll answer. Anil will answer the questions for you. Okay, now the biggest, hottest topic of the time in the world: work from home. So So with this work from home thing, with COVID and many companies doing all the work from home thing, so how does the work from home and home office can help on our taxes?
Okay. This is also a very common question which I'm getting this year. If you are on W-2 employment, if you're working for someone, straightforward, simple answer: work from home is not a tax deductible expense for you. You just forget about it. Work from home is only for the self-employed individuals or contractors or for the business owners, not for the individual contributors. So that is why I say that always you need to be in business somewhere. It can be a side business. When you are working, you can be doing maybe some mortgage agent, you can be a real estate agent, you can be a financial advisor, you can be a tax consultant, or you can be an interior designer, or you can be even doing a kitchen at your home. Whatever it is, though you enjoy a lot more benefits when you have a business sidekick. But if you're in W-2, even you are working from the home for the last 2 years, you will not be able to even deduct even a single dollar as a taxes from your tax return. But if you are a business owner, if you have any side business, then yes, as long as you use the place exclusively and regularly for your business, then the answer is yes. Like example, watching before you are sitting in the couch and watching the TV, and you say that, yeah, I am working from here and this I consider as a home office. No, you have to use that place exclusively for the business. An example, right now I am in a home where I'm in the sitting or the office. What I'm sitting now, this is an exclusive place I use for my home office. So then, if at all, once you have a business, and if you're meeting these conditions, then whatever money you spend for your home, electricity, mortgage interest, or depreciation, or utilities, or maybe maintenance, cleaning, or any repairs and maintenance, painting, or there's maybe gardening work, whatever money you spend on your home, a specific percentage, it can be 5%, 10%, 15%, based on how much space you are using for your home office. That percentage can be tax deductible from your as an expense from your business, but not for a W-2. So
okay, Great point. Thank you so much. I'm sure everybody's learning from your conversations and your pointers. But I'm not going to contradict you, but I'm going to ask you a question on the same thing. For
Please.
example, when they say home office, they are using the home office. It can be a separate room in their house. They have furniture. They have computer monitors. They have all the
Yeah.
external hardware. They have a printer. They have internet connection. Doesn't that all come under home office for W-2s?
Oh, okay. W2s, what IRS said is, so after 2018, IRS said, don't ask me any deduction, just take the standard deduction 25,100, adjust with that.
I see.
Earlier, it used to be 12,000. So now they increased the deduction because everyone was asking for a lot of deductions. They said, if you're a W2, don't ask me more, take $25,100 and keep quiet. No deductions.
I see. I see. Good.
Yeah, and because I
Thank
am
you.
running my business now as a tax advisor, so now I can detect everything. I have a monitor, I have a laptop, desktop, printer, cables, lights, what everything is tax deductible as long as I can show that they are legitimate and I'm using it for the business.
Yes. Perfect. Thank you. So, how can homeowners actually and really save on the green energies?
Okay. So this is not very popular in our area, but there are some credits are available. So if at all, if you're going and buying a solar equipment like solar panels, so then definitely you can claim energy. So then you can get a tax credit for that. So this credit is a direct dollar to dollar credit. It means if we have some tax liability, maybe some $20,000 tax liability, and if you get some $5,000 as a solar credit, this 5,000 can be directly deducted from your $20,000 liability. It is called dollar to dollar reduction. That's one. Then, if at all, if you buy any solar equipment or solar panels, or we call it as solar PV systems, you are eligible for some tax deduction, some tax credits. It is 26% of the total investment. First year you get it as a 26%. No, I'll put it in there. If you are filing your tax returns now, and if you bought a solar equipment, solar PV system, which can be installed on your home, whatever money you invested, 26%, whatever money you invested in the last year, in the year 2020, you are eligible to get 26% flat tax credit. Example, if you invested $30,000, $30,000 into 26%. So $30,000 into 26%, approximately $7,800, you get it as a tax credit. But if you're buying the equipment this year, then it is only 22%. And it will be going down. And this is available only up to 2023. After that, it's no more.
Okay, great. What about the electric cars?
Okay, electric cars is again, you need to get a certificate from the respective what you call the car dealers, saying that you really invested money on an electric authorized IRS approved electric cars.
I see.
So you can get up to $7,500 is what you get.
I see. Okay, thank you.
But if you don't get the credit, but if you don't get a certificate from them, you're gone. You will not be getting the credit.
Okay, perfect. So how can we save taxes on investing for education?
Okay. So again, this is not so popular in our state because there is a very popular plan called 529. If you invest money for in 529 plan for your kids, you will get a tax deduction only in some states. And there are two types of taxes: federal taxes, state taxes. Federal taxes doesn't care. Wherever you invest for your kids' education, then you don't get any tax deductions. But some states, like maybe some Chicago, I want to give. So there, if you're living there and if you're contributing there, or if you're living in a Missouri state, if you're contributing in 529 plan for the state supported one, for your state tax returns, you get a tax deduction, not for the federal level. So, but there are many other plans are available rather than 529. I personally don't like 529 plan because of the limitations. But I don't want to divert the topic. I have two kids. but I don't contribute to the 529 plan. I do as on other plans which I contribute,
Okay.
but I want to cover it in a separate topic. Not we are already running short of the time here.
Right. Yeah. Thank you. So, tax-free bonds, like municipal bonds, and how do they actually help us in reducing the taxes and get a benefit?
Okay. Again, tax-free municipal bonds. The example I want to give here is just for easy reference. It's called a municipal bond. It's a government-supported one. If you
Right.
make any income, if you get any interest income on these bonds, those are tax-free income. But typically, the interest incomes are very less, maybe 1%, 2%. So I personally don't prefer it. So
Okay.
and those bond prices varies all the time. And like example, today I invested $10,000 in the municipal bond, and maybe after 5 years this value may become 10, may become 11 or $12,000 based on the interest rates. But I need to pay capital gain taxes on the additional income whatever you're making when I sell
Right.
it. But
Right.
every year on year, if I make any interest which is very immaterial, that is tax free. So but I mean, because
Perfect.
our Indian backup, the interest whatever I see there is negligible, I shall say,
Right.
considering our Indian
Understood.
interest rates. Yeah.
Thank you. I'm going to ask you your most favorite question for the evening. Having a LLC, which you have already said so many times. Having a LLC, is it good? I want you to reiterate what you just said. It's like everybody should have their own business. Do you want to reiterate again and let
Yes.
everybody know what that actually means?
I insisted on Roth IRA account. Again, I will insist on having a business. Everyone, whoever living in America, and if they have proper visas, I don't want to get into immigration, but if they have the proper visas or valid
Right.
authorities, I want them to start a business. If anyone is not having the business, they are not utilizing the opportunities or resources in a large extent to the optimizing. They're not optimizing it. So simple, wherever you work, you don't need to leave your job, but start working on your passion and start build. Like example, for an example, I was working for Amazon. So when I was working for an Amazon, then I worked in a Starbucks. Then I started my business as a part-time. I started with my passion. After 6 months, I see a substantial growth in my business. I quit my full-time job and I became full-time in my business. But on top of whatever the business I make, I also get a lot of tax advantages. I want to give at a very high level what are the advantages we get. That if we have the business, the effective tax rate will go down substantially. An example, right now you may be paying an effective tax rate of maybe 25% to 30%. But if you have the business, in many cases I see that you pay only 15% or even 5% or even 10%. Because business, if you have the business, you are opening up the doors to get lot of tax advantages. America is a great place to have a business. Government came forward and to supporting a lot of tax advantages. I will start with a few, considering the shortage of the time. I will give it very high level. What are the advantages you get? Wherever we already discussed about the home office. On average, people get tax benefit of $3,000 to $5,000 in net taxes in taxes they save because of just home office expenses. They can claim lot of expenses, like example, on top of the utilities, rent or utility or mortgage interest share or otherwise maintenance or cleaning, pest control, whatever you pay, 10, 15, 20%, you get it as a business deduction, number one. And I'm talking about it's illegal. I'm not talking something illegal on the recorded session. It's illegal. You can deduct it. Then you and whatever you buy, as long as electronic items, you can buy an Apple Watch. That is a tax deductible because you get an Alexa about your business, meetings, and you can buy monitor, laptop, desktop, iPads, or those are tax deductible. Travel, wherever you go, as long as you can find a purpose of your visit connected with your business. Like example, I am a tax advisor. Wherever I go, like example, if I go to the Texas, if I go to the Houston, I may go and find some consultant, some client there. If you go and prove that, or if I can go and attend a seminar, or in maybe some conventions, business related, or if I am a real estate agent, I may go and find an area new. I'm exploring new area to serve. So these are a lot of areas, and those are all my travel expenses are tax deductible as long as you can prove it is a legitimate and business. I'm not asking anyone to misuse the opportunities. Use it effectively. There is an opportunity, use it. It's illegal to you try to see that how you can make it a business trip rather than personal trip. So then those expenses are tax deductible. And apart from this, retirement accounts. I mean, we will have one more session exclusive on the retirement on some other time. But you can get more opportunity to contribute to the retirement accounts rather than what you're contributing now. Right now, you can maximum you can contribute is only $19,500 for your 401k account. But if you have a business owner, you can go up to $58,000 as a contributor, and you can get a tax deduction for your complete tax deductions. And also travel, cars, vehicles, whatever you buy, lease payments, mortgage payments, all those can be a tax deduction. Then imagine all these expenses will pull down your total tax income. And all the beauty here is, initially when you start your business, you may not have a lot of income, but you have all these expenses. If you have any losses in your business, these losses can be adjusted with your W2 income. So obviously your net total taxable income will go down, tax liability will go down, the effective tax rate will go down. So anyone has any passion, or if you have anyone has extra free time, I strongly recommend you to go and start a business. I have few hundreds of clients. I talk with a lot of business ideas every time. If anyone wants to think about, hey, what business I can start, just talk to me. I will help you. I will guide you.
Thank you, Anil. For the viewers on the call, we will have a recording on Facebook. Please feel free to send your questions, and we will be able to answer. But before I even close, I have one last question on the same topic you were talking about, having corporation of our own. So which one would you suggest, a LLC C Corp or an S Corp?
Okay, straightforward, I recommend everyone to go with LLC first. So there are three types of, at a high level, there are very popular, there are three types of structures: LLC, limited liability company; S corporation; C corporation. So LLC, anyone, if they are thinking about starting a business, just start with an LLC. LLC is straightforward, easy to manage, easy, less compliances. So for all whatever the side businesses I said, just start with an LLC. Then S corporation, if you're thinking about net profit from the business is more than $50,000, then only think about S corporation. And the third one is C corporation. If you are developing a product, or if you want to go for a listing, public listing in the future, then only consider about C corporation. Otherwise, if you want an international shareholders, you want a partner from India or maybe from Singapore, then think about C corporation. So at a very high, but summarizing, considering our first set of meeting, because we're talking about the basics, just start with an LLC. And LLC can be converted to an S corporation. LLC can be converted to the C corporation also at any point of time in the future.
Perfect. That's an awesome information. Yeah, thank you so much, Anil. That was wonderful talking with you. Great information. I'm sure everybody on the call who's listening to your conversation might have gotten good information. And again, please send us your questions while you review this recording or watch this recording again. Or anybody at any time, if you actually have questions, you come up with questions, please do send us the questions in the chat, and Anil will be able to answer. Thank you so much, Anil. And I guess this is it for tonight.
Yep, thank you very much, Prasad, and thanks to Seattle Wala. Your initiative, I really liked it. You are encouraging local talent and sharing the knowledge with many more community members. And I strongly believe at least my last 1 hour of presentation, even it's helpful for a few people, I would be very glad. And if you want to,
I'm sure it is, Anil.
Yep,
I'm sure it is.
Yeah. And if anyone wants any more details, whether you are client or not, feel free to schedule a meeting with me. I'm very much happy to help you to answer your queries. And I'm just posting my my website link so that you can go through the website and you will have all my contact details and everything. And I also post my YouTube playlist, so where you can go through a lot of articles. And if you want to learn more about me, Google search Anil Grandhi. You will find lot of articles, lot of information, many videos, and everything is very, very knowledgeable. And just my purpose is, my intention is just to share my knowledge. So that's it. Thank you very much, Prasad Garu.
Awesome, sir. Awesome. Thank you. Thank you, everyone, for participating in this conversation. You all have a great rest of your weekend, and we will see you all soon.
Thank you. Bye-bye.
Bye.